Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. This week, we are expected to hear from the Federal Reserve as they raise interest rates this week. So it is not official yet. We may hear either Wednesday or Thursday when it becomes official, but the stock market is going to be paying attention to a few things. You as an investor, you should be paying attention to a few things as well. The big question is, how aggressive will the Federal Reserve be? Are they going to raise it by 25 basis points, that's 0.25%, or 50 basis points, which is just a half percent, so 0.5? How aggressive are they going to be about fighting inflation? As you know, inflation is as high as it's been in 40 years. Okay, we know that. And we know how we got here. Pandemic, Russia, you put that together. I mean, that's pretty much the summary of why prices are extremely high for most things across the board. So the Federal Reserve, by raising interest rates, they discourage consumers. They discourage businesses that say, hey, look, let me think about this twice. Hopefully they can reduce demand, which should in turn reduce prices. So for example, mortgage interest rates were just under 3% last year. When I bought my house, this house here, we didn't pay 3%. It was just under that. It's like 2.9 or something ridiculously low, whatever it was. Today, those mortgage interest prices are about 5%. And that means for a median priced house in the United States today, that could cost you an additional $370 per month. That means that most people who are just doing the math on buying a house, you might be like, I don't want to buy that house no more. Instead of having 50 bids for houses, you might get 25, you might get 10, and it slows down a few things in the economy. But the market, as well as consumers, are going to be looking at this. How aggressive are they going to be? Because obviously there's a limit. You can't raise interest rates, thus raising prices by too much, because you can push us into a recession. That happened in the 1970s. But also you can't be too slow to stop inflation and only raise it by 0.25, because inflation is still eating at our pockets and it's still hurting the stock market. So the Federal Reserve really has a difficult job, and they're in a really unwinnable situation, if you ask me, because you could say this. Let's say they raise it by 0.25%. The headlines in the news could be, Federal Reserve does not take inflation seriously enough, and this interest rate hike hurts us because it's going to make things more expensive, but inflation is still going to hurt you too. Or you can get a headline saying they raise it by 0.25%. They are going to be too aggressive, too hawkish, as they say, and push us into recession. Both cases will lose, right? Both are negative. Both are negative interpretations of that. The only positive interpretation is we expected a 0.5% interest increase, increase in interest rates, but it's only 0.25. Yay, we've saved some money. That could also be a positive thing, where you thought you're really going to get grounded for 2 weeks and then you realize it was only 2 days. Hey, stock market's up. That is a possibility too. But of those three scenarios, two of the three scenarios, two are bad. So we'll see what happens and how the market reacts. I don't know, because stock market can be quite illogical at times. But as an investor, here's what you need to know. You should do nothing. You should do nothing. I don't think that whether they raise it by 0.25% or by 0.5%, I don't think this is a signal for you to go out and buy anything unless this was your regular time to dollar cost average. Mine is on Friday. I think the move is expected on Wednesday or Thursday. So I'm just going to miss that day. And I'll be right back in the market on Friday, regardless of what they do and how much they raise it by. The thing is here, you should have, at this point in May, especially if you've been watching the channel since January, if you haven't been subscribing, you need to do that right now. If you are new and it's the first time you've been here, welcome. You should also subscribe. But in either case, you have had the opportunity to reposition your portfolio. Y'all know I do it twice a year, December and June. And back in December, with the information we had, I made a few tweaks. It's one of the few reasons that I kept Capital One. That's not working out well. One of the few reasons why I kept Target, because interest rates were going up. While we didn't really know there was a fear of fear of recession per se, I wanted to keep it. I knew it was a bit more defensive, and defensive stocks usually do well when inflation is up, but also when interest rates go up, because they have pricing power. If you are going to Walmart and Walmart has increased their prices by a penny, you're gonna need that stuff, right? Costco, Dollar General, all that kind of stuff. Dollar Tree is why a lot of those stocks have been doing well this year. Now, we thought banks were going to do well too. That wasn't necessarily the case. So for me, I'll be making that adjustment in June. Now, if you don't do yours twice a year, which is fine, you do what you want to do, you should be doing it quarterly at most. You don't want to do it weekly, you don't want to do it monthly. But at this point, we've done enough inflation videos. We've done enough talks about defensive stocks and healthcare and dividend stocks and all that kind of stuff, insurance, and all the places that tend to do well in this type of environment that you could have made those changes by now. Can you still make it this week? You can. It's not illegal to do so, but the positioning needs to have been done already because it's not the only interest rate hike that you are going to see. We already saw one just a few months ago, and we're expected to see anywhere between 4 to 6 more, right? Not just including these two. You can see 4 to 6 more this year alone, and those how many you get, that really depends on who you ask. Some are saying 4, some are saying 8. People all over the place. The point is, rates are going up, and they are going to continue to do so. You need to respond, and I think you should have responded already. We're already in May. The first quarter was over in March, right? So we've had enough of a pattern to know what's working, what's not working, what is a real value in the market, and what is not. So you want to make those small tweaks. It doesn't have to be big. You don't need to sell out of everything and go 100% defensive and 100% like conservative. I don't think that really makes sense. You just want to make small tweaks and make sure that you are protecting yourself to a degree while also taking advantage of what could be some pretty steep discounts on companies that are really good, that are truly of value. I believe a lot in Apple, and Apple proved that. Apple proved that with their earnings. I think they had like somewhere between 7 to 9% increase in revenue and profits. They were good, even though the stock is down this year. That makes a lot of sense. And they're not down 70% like, a PayPal or Netflix, right? So I'll take that. I think Apple might be at a discount, right? So these things, we've known this for a little bit now, right? We're 5 months into it. You got to catch up. You got to start to make just tiny adjustments here and there. And the most important thing is you don't want to overreact this week. That is what's going to happen. I guarantee you there are going to be posts on Facebook, posts on Twitter about everybody complaining that the Federal Reserve is doing this and doing that, and their portfolios are not doing what it should be doing. If you have been paying attention, you saw this coming for a while now. Go back to the page, type in inflation and put in either my name or Building Bread, and you will see we have been documenting this for quite a while and been talking about putting yourself in position for scenarios exactly like this. So it's not time to overreact. I don't know, and I can't tell you where the market is going to drop significantly. We had a 900 point dip in the market. What was that, last Friday or so? That may happen. If it does, I'm not going to be shocked. It's not going to shake me in either way, whether it's Wednesday or Thursday. Or you can see a significant pop and have the best day since, 1993. Picking a year here. It doesn't matter. To me, it doesn't matter. I don't think this is an investable event. I don't think you have to make a move. Those moves that you think you should be making or that you will think that you need to make Wednesday or Thursday, I think you should have did it already. And that you should be consistently adding to whatever those moves will be. Okay, so my thing is stay ready so you ain't got to get ready. We've been talking about inflation for a while. If you was going to make that move, should have been moved, right? And if you are on your dollar cost average holding what you got, you should be holding what you got. Unless your dollar cost average day is on Wednesday or Thursday, leave it alone. Leave it alone. Turn off TV, turn off the news. It's going to shake somebody. Somebody going to text me and say, hey, should I sell my 401k? The answer is no, but don't. This is one of those scenarios where the market is going to overreact to something you knew was going to happen. Okay, I'm telling you now, this ain't going to be the only interest rate hike. And I'm telling you now, the headlines are going to be focused on, is it too aggressive at 0.5 or not aggressive enough at 0.25? It's going to be one of those two, usually, right? Of the three scenarios, I think because the market's down, I think we're more pessimistic, and those are going to be the two ways that the market's going to go. So it is what it is. We can't control it, right? Unless you want to stop buying stuff and stop demand on your own, you could do that, I suppose. But it is what it is. The market is down. This is a value season. It's a defensive season. So you need to go into those areas a bit and just hold tight. like I've said this before, I've said this on TikTok and on Instagram and other places, and I think we said it here too, this is the cost of doing business. Okay, you got to go through markets like this to hit those all-time highs. You got to go through markets like this to reach that millionaire level. No millionaire who has ever invested for any length of time, really, unless they got hit the jackpot, but most millionaires invest for 20 to 25 years. And no point, I don't think we've ever had a 25-year period where the market was up every single year. That didn't happen. What happens is you take, the market tanks from time to time, and you take advantage by holding, by consistently dollar cost averaging, and by being focused and understanding what's going on and taking advantage of the situation. So for me, I've said this before, I think Apple makes a lot of sense. It's one of the few tech companies, and Microsoft too, but it's one of the few companies that drops in value. I'm like, hey, I'm gonna keep buying some more. But then on the other side of things is, hey, I got defensive stock, I need those dividends, let me go ahead and buy here and hold here and get quality. This is where the high flying, it worked in the pandemic, that stuff not working no more. It hasn't been working in 2 years now. It ain't worked since 2020. You gotta refresh, right? So this is your opportunity to do that, and you've had opportunities this entire year. So this week it's non-reactive time. You knew it was coming. I've been talking about it, and it's gonna be more. Okay, so I'm telling you that right now too. All right, so that is it for me. It's gonna happen Wednesday or Thursday. We'll see. I'm not really concerned on what day. I will probably cover it because it's gonna be in the news. But again, should you invest? Should you do? Don't ask me what you should do. I already told you. I told you in this video. And I told you in the last 8 videos. Okay. All right. We all know. All right, y'all. All right. I'll talk to y'all tomorrow. I got some really important content that we're going to continue to discuss around investing. But also, this is y'all channel. This is y'all channel. You get to shape the stuff that I talk about. So if you got questions and things you want me to cover, feel free to drop those in the comments below. All right. That's it for me. Talk to y'all later.